John McNertney here. Boa tarde, if you are east of the Atlantic Ocean, and if you're west of it, first of all, I'm sorry, and good morning. Hopefully, you are doing well, and welcome to another one of my webcasts. Today, the extremely exciting subject here: are we going to get taxed on our pensions in Portugal? Now, I know what you're thinking. That's a yes/no question. And I should probably just answer it right now, but I'm not gonna because I want you to be hanging on the edge of your seat. But before we start talking about taxes, a brief disclosure, although I am in fact registered as an investment advisor and I am registered with the Certified Financial Planning Board, this webcast is not actually bound by any client privilege. So all of the information is presented as is with no intent to give specific investment advice for you. If you want that, then you should come and talk to us one-on-one. Who are we? Um, well, I'm John McNertney. I'm a certified financial planner and a multiple decades resident of San Francisco, California, who has been, among many other things, riding motorcycles around Portugal. I took this picture last weekend. I thought it'd be more fun than the stock image that I am usually using. I started this company a few years ago. Previous to this, I had another life doing the same exact thing in America. And I lived in Iowa, where I attended the University of Iowa for 4 years, of course. And I had a lot of foreign language exposure at that time. But right now, I am a financial planner, and I work with a few gentlemen here as well. Ryan and Mark are other associates here at Green Ocean Global Advisors as well. We've been growing. Thank goodness for that. So today, today we're going to be talking about the pensions that we bring with us when we move to Portugal. And although this information is specific to Portugal, if indeed you are moving east to Spain or to Italy or to any number of other European destinations, as I have been learning, many of these countries are fairly similar on a lot of points here. All right, just a brief housekeeping note. If you would like these slides, totally happy to share them with you. Please just email me after the presentation has concluded, and I will be very happy to send you a PDF of everything that I'm about to share with you today. Goodness knows it's mostly public information anyways. I also have the chat here. In case you have specific questions, please just go ahead and chat them straight out at me. I can't promise I'll get to them immediately, but I will answer them. And we will be having a question and answer session at the end of the presentation in case you'd like to just sit back and enjoy the ride. So outline, we're going to have the basics. We're going to talk about why Portugal at all for just a minute. I saw some names in the registry here of individuals that may not be in Portugal yet, and they might not even know what I'm doing here. So I'll talk about that first. Then we'll talk about the US-Portuguese tax treaty and how that pertains to pension income. And then we'll talk about the actual point of fact. What, if anything, will be our assessment? What is our tax liability on our pensions before getting into Q&A? So let's get started. Benefits of retiring in Portugal, just in case one needs to be reminded, is because it is gorgeous here. Portugal was an unknown to myself before I visited it in 2019, but of course I was struck immediately by its beauty, both its natural beauty and the cultural beauty that Portugal has to offer. I have met some of the kindest people over the last few years that I've met in my whole life. Very open-hearted, very generous and warm people, just like the climate. This is a picture I took about a month ago. We took a Camino de Santiago, a trip north through Portugal. The cost of living is famously low in Portugal, although that factor seems to be changing, which sometimes makes me wonder if I am part of the problem. But it is a relatively low cost of living country. Rent, utilities, and all of the things that you encounter on a daily basis are uh, half to less than half of what you may be used to paying for, particularly in the categories like food. I return to the United States frequently, and the comparison never fails to amaze me of how much more expensive parts of the United States have become, particularly my native San Francisco, California. It's also a very safe country. Portugal currently ranks as the sixth safest country to live in the world. This is a statistic from the Global Peace Index in 2022. And it is indeed a safe feeling place. Again, I come from a major metropolitan region in the United States, and there's no basis for comparison, of course, but really and truly, the people are very laid back, very easygoing, and the only kind of crime that you may encounter if you do is petty theft. Of course, crimes of opportunity happen when you leave stuff out. It's always the case anywhere you go. And if you were an optimist, raise your hand if you think that Portugal is a tax haven. Anybody? You may not already live here because Portugal can be less expensive in taxes, but it's not always. And so the comparison here is that in the US, federal tax rates go from 10 to 37%, depending on your income bracket. But those brackets in the United States are much, much taller. So in order to get to the 37% bracket in the US, you need to be making more than $578,000. Yes, it's true. So with the deduction, you are going to be above $600,000. And in Portugal, the income tax brackets are very short and the rates go very high. So 48% is the much dreaded top rate. And you're hitting that rate when your joint tax return, sorry, I'm giving joint tax return numbers, when your joint income level is above 81,000 euros, or about $85,000 today's rates. So if you think about your average American, especially where I'm from in the San Francisco Bay Area, you're very quickly going to be getting up into the 80s if you're making enough money to live at all. And there are some tax savings that can be had, especially if you qualify for the NHR regime, which was just terminated. And so we can only hope that the government will revise the cessation of NHR. But hope is not a strategy, as the old saying goes. But if you had the NHR, if you have it, then you will in fact receive a 10% flat cap on taxes assessed against your pension income, and that's wonderful. Your capital gains taxes in Portugal are a flat 28%. It's actually kind of high, even under NHR. So yes, if you're receiving lots of capital gains from US stocks and bonds, then you're going to get taxed at a flat 28%, and flat 28 if you on property if you're not under NHR. Once again, if you have the non-habitual residency designation, you will be treated to lower tax rates on real property, on homes in the United States. So that's the wrap on the most consequential, at least in financial terms, benefit of living in Portugal is lower cost of living, healthcare savings. You have a slightly lower property taxes in Portugal as well. Planning for retirement. Okay, so we'll talk about planning for retirement, and then I will answer the yes or no question. So some of these images that you see on the screen here, these are actual live pages without information on clients, of course, from financial plans that I have done. And so we have to look at cost of living if we're going to be moving to Portugal, as I've said. And then you have to look at the cost of healthcare. They're lower. They're just lower across the board. You're also, of course, going to have to deal with your residency requirements. You need to get your visa in order before you come over. And you'll need to go through the sometimes tedious process of setting up your banking and financial relationships in Europe. You're also going to have to figure out what to do with your investments back at home. We prefer to use Charles Schwab at Green Ocean Global, simply for the reason that their international jurisdictioning process allows them to serve Americans that are in Portugal on essentially the same basis that they do before they leave the United States. So you can practice without restrictions, in essence, if you use Charles Schwab International, with some exceptions. If you know what those exceptions are, we don't have to talk about that right now, but there are some exceptions. Um, uh, Steps to take for a smooth transition. Again, if you're not in Portugal and you want to move here sight unseen, then I think you're just a little crazy. I like you, but you're a little bit crazy because you should do a scouting trip. You should go through all of the documentation that the Portuguese authorities will require because they certainly will require documentation. And you should plan your health care and your housing arrangements before you move, for sure, as well. Legal and regulatory considerations. Well, I'm not going to go deep into the weeds here. We're talking about pensions today, after all. But we should give some treatment to the fact that you need, of course, to figure this visa out. So there are a variety of there are a variety of visas that you can seek. The D7 visa is aimed at at the broadest class of individuals that have passive income in the United States. They need to demonstrate that they have at least 820 euros coming on a monthly basis. Um, then there's the golden visa, on the other hand, which you may apply for if you want to make an investment in Portugal. The minimum amount is 500,000 euros now. So you better be ready to pony up some dough if you are interested in obtaining the golden visa. Let's just move on and discuss the most consequential piece of information that any of us, I think, can get their heads around, which is the tax treaty, right? And so the tax treaty was signed into law pretty recently, in 1996. And the whole purpose can be summed up pretty simply as this: double taxation. It just wants to eliminate double taxation. All right. There are other aspects to the treaty. For example, I mentioned earlier that capital gains can possibly be mitigated with the tax treaty. It's possible, okay, because there is a saving clause at the end of the tax treaty. There's many different facets within the tax treaty that can be important, but the one thing you really need to remember is this: is it's just dealing with double taxation. That's that's really the big deal here with the tax treaty. The treaty specifies how pensions and other retirement benefits are taxed. The key is you need to establish your residency. So pensions and other similar forms of income are generally only taxable in the country where you live. So have you been in Portugal for 183 days? If so, you have become a tax resident. Have you purchased a residence in Portugal and have you assumed domicile in that home? Have you moved in and told the tax authorities that you've moved in? Those are the two primary ways that you can now become a tax resident. And now that you're a tax resident, all of the forms of income that are coming to you, including that pension, they're going to be taxable in the country where you're a tax resident. Congratulations. Pensions paid by government to your former employees for services rendered are usually not taxable. So this is the one exception. If you were an enlisted person in the military, if you worked for the federal government in any capacity, and you now have a pension that is tied to your service as a government employee, that's actually going to be taxed immediately, and it will not be taxable in Portugal. So that is an exception to the rule that everything will be taxed to the country where you are a tax resident. Government pensions. And there are going to be times when pension payments are taxed in both countries accidentally. So, for example, Social Security, if you receive a large Social Security check, a certain portion of that Social Security will be taxable immediately, right? So I think the number now is 30. It's in the high 30s in the United States of America if you're earning more than 30 from your Social Security and or or you have other income. If your total income exceeds thresholds that are above 50,000, then you should be aware that the US will tax some of your Social Security. And then Portugal will too, right? And so as we're going to see, there are ways that you can then seek relief. You can you could basically furnish evidence that you've been double taxed, and you can seek a reimbursement from the country where you are not a tax resident. All of these things, all of them, are found in the US-Portugal tax treaty. So if you haven't done it, I would highly recommend you put the kettle on, make some coffee, and get through the entire document. It's very helpful to know these things. General rules for taxation. General rule is, like I just said, you're going to be taxed in the country where you live. Let's see, withholding rules. There's nothing here that we haven't talked about except for this last piece, withholding taxes. So the tax treaty specifies reduced rates for withholding taxes. This piece is important. Remember how I talked about how Charles Schwab is our favorite broker because as a tax resident of Portugal, you can continue to keep your accounts with Charles Schwab. They're going to be just fine with it. That's true, although I should put an asterisk next to that statement because they're going to start withholding automatically at the rate of 30% on all of your investments, gains, when you take capital gains, or income slash dividends. And the only way that you can get around that is by making sure that the tax treaty is tied to your account. That's right. So when you have a Charles Schwab International account, and I imagine Interactive Brokers is the same because we use both of those custodians at Green Ocean, both of those entities is going to need you to claim the treaty position when you open up your accounts, or they're going to tax you at 30% withholding, and you're going to have to try to get that money back later. Don't do that. That sounds much more difficult than just filling out the little bubble that says I have the tax treaty. And you do have to write it in. It's on page 7 of the Portugal/US tax treaty. So that is generally how this works. There are going to be other things. It's not just Charles Schwab, I'm sure. There are going to be many forms of income that you can receive where you are going to have to be aware of and specify that you have coverage under the tax treaty, or your professionals will do it for you. Obviously, I've done this many, many times for other people, but you can do so on your own as well. Double taxation relief. I guess these are just terms. I did put this together. I'm making it sound like I didn't. But you need to understand what double taxation means and what it does not mean. Double taxation occurs when the same income is taxed in two places. That's really it. To mitigate this, the tax treaties exist. And in case you do become the subject of double taxation, which it will happen, it's going to, then you're going to need to seek relief. Okay, so when you become a tax resident in Portugal, this means that every year you simply will have to seek a method of exemption. That's the foreign tax credit, or it is, what is the other method? I didn't put it down here. So it's the foreign tax credit or it's the earned income exemption. Yeah. So those are the two ways that when you file your taxes, you are going to either yourself or you will instruct your tax preparer to ensure that they choose one of these two methods in order to claim your exemption or your tax credit. So in case that's not clear, basically you're going to get taxed in both places, and then you have to tell the country where you're not a tax resident that you've already paid taxes in the country where you are a tax resident. So I'm living in Portugal, so I have to every year file with the IRS and say, I'd like to get the foreign tax credit. I paid a lot of taxes in Portugal, and then you get a dollar for dollar credit on the amount that you paid. I hope that's clear. Taxation of US pensions in Portugal. So here's the answer. Yes, is the answer. Are they taxed? They're totally taxed in Portugal. And in fact, take a picture. because this is the ugly truth, is you will be taxed 48% when you go above 81,000 euros. That's right. And that will apply to all of your US income, except for certain classes. So US pensions received by residents of Portugal indeed are subject to Portuguese income tax. The tax rates are the standard applicable rates, 14 to 48%. But if you have the NHR, bless you, be grateful because you will be taxed at just a flat rate of 10%. The amount of income that is assessed at 10% will be added to your overall adjusted gross income for the purposes of calculating your other forms of income, but you're not going to be hit with the standard tax rates here on your pension income. The differences between public and private pensions, the differences between public and private pensions has already been explained. Social Security, I am sorry to say, is under most circumstances also going to be fully taxable in Portugal. This will probably be the greatest source of additional taxation that you become the subject of when you are not under NHR. So U.S. Social Security benefits received by Portuguese residents in Portugal are generally subject to Portuguese taxation. They are also taxable in the U.S., as I've said, if you exceed certain hurdles, certain thresholds. Your other retirement income, IRAs, 401ks, 403bs, 457s, the whole lot of them, they're going to be taxed too. Be very, very careful here. I'm going to say this once, but I'll say it again if you ask me later. But these are by default taxed at standard Portuguese tax rates. Okay. Now, if you found me because I was on a tax webinar with a tax company last Thursday, then you will also know this. There are exceptions to this rule. Okay. The exceptions to this rule are only accessible to those of us that work for this exception to be made for us. We have to hire a tax professional who will then file our taxes not through the standard finances process, but in person, in paper, and they will interpret your taxes using the tax treaty as well, actually. But there is a way that you can have your retirement accounts qualified as a pension or as an investment account with some very interesting consequences. But you must claim these things and and sort of avail yourself of the somewhat subjective Portuguese tax system. And so here we are. These are the strategies that you can use to minimize your tax liability. Of course, this is a no-brainer. If you have NHR, then you're going to benefit from the low rates that NHR recipients receive. Tax treaties, credits, you want to time your income. Okay, so timing of income, what I'm thinking of here is there are some of us who have our own companies, or if you're going to be selling an asset that generates income, or if you're going to accelerate the distribution of income coming to you from various retirement vehicles. There's options at times. You can sort of accelerate these either before you arrive, or if you have NHR, there are exceptions that you can take advantage of to do it during the NHR timeframe as well. And then there are tax efficient investment vehicles. Here I'm thinking things like Roth IRAs, which offer tax-free withdrawals with a big asterisk, another form of controversy, which in fact I am happy to talk about, but usually offline because people get a little bit, they get very excited about that, as I would as well. Tax efficient investment vehicles. Yeah, anyways, that's enough to be said about that right now. So case study. This is kind of like an exam, but I have one Q&A here from a while ago. There is a question I'll take. Do you need to open a new Schwab account if you already have one when you're moving to Portugal? It's not a new account, Jonathan. It's not a new account that you need to open, but you do need to move the account over to Charles Schwab International. So it keeps its account number, but it does need to be repapered. That they're going to require you to fill out an application. So it feels like a new account, but you'll maintain your logins and your accounts will still be tied together, and the cost basis information won't move. There's there's a quasi uh, smooth experience there. So case study. So here is a client, 65-year-old federal employee who's planning to move to Portugal to enjoy his retirement. 65, I want to move to Portugal. I'm with you so far. He receives a U.S. federal government pension of 50,000 and is interested in understanding the tax implications of relocating. He wants to use the NHR. Perhaps he's on the transitional regime and he knows something that we don't. His primary concerns include ensuring compliance with both US and Portuguese tax laws, avoiding double taxation, and maximizing his pension's tax efficiency. Okay, so he's 65, he was a government employee, so we know he's probably going to receive the benefit of not being taxed on his US pension, um, at least the government one. So his challenges are, we want to understand the tax implications of moving there with a U.S. pension. We want to determine how that U.S.-Portugal tax treaty applies to the pension. We want to avoid double taxation. And we want to comply with both U.S. and Portuguese tax filing requirements. Sounds easy. So John confirms that he's a U.S. federal government. Pensions are only taxable in the U.S. He's got a private pension, and he has the NHR regime. And so he is going to be taxed at a flat 10% tax rate. He's established tax residency in Portugal by spending more than 183 days in the country. As we've said, that is one of the two ways that you can become a tax resident. And he has applied successfully for the NHR regime to benefit from favorable tax treatment. He's filed the necessary forms with the IRS, the Form 2555, and he submitted tax returns in Portugal. And so he is compliant. Yes. That was a pretty easy one, actually. Next time there's a test, I'm going to give you some hard ones. But the outcomes here is he does have the ultimate in tax efficiency because he's lucky. He leveraged the NHR regime. He has a clear understanding of his tax obligations. He's avoided double taxation because he's done some homework. I imagine if you were completely unaware of all of these things, you could end up paying taxes in both countries. You do have to file your proper credits or exemptions. And why not? Let's do some financial planning as well, so that he can understand what his income will be post move. So the takeaways here are that the US-Portugal tax treaty does indeed provide clear guidelines to avoid the double taxation. The NHR regime is great, and maintaining US and Portuguese tax compliance avoids being hassled by the tax regulators in either country. So we're nearly to the end, but we got some interesting comments actually. Um, it's a really good question. The state pensions qualify as non-taxable in Portugal. I don't know, Christine. We have to figure this one out because I've actually, uh, just recently, I've come across this several times. I don't think so. I don't think so. But as it so happens, I can put my question over to a friendly Portuguese accountant. And so I'm going to write that question down and I'm going to ask for you right after this webinar today. And we'll get some clarity on that. I believe that there is an exception to government pensions being tax-free by Portugal. It's my understanding that once you become a Portuguese citizen, your U.S. government pension is taxable by Portugal. That's a good point. So what this anonymous attendee has just pointed out is that once you become a tax citizen, um, uh, once you have been here for 5 years, and then maybe the 3 months to 2 years process to become a citizen, that there is an exception to being tax-free in government pensions, and that is that you're going to be taxed, and that is my understanding as well. But if you would like to become non-anonymous and also get a direct line to a Portuguese tax advisor, I will ask that one as well because I want to double check that. But that's my understanding. I am not a tax citizen. I will become one in a year, but I'm not receiving government pensions, so that doesn't affect me. What about pensions? Ah, okay. So Marta, I will definitely come back with you on the state government question. I'm actually sorry that I haven't, I'm a little embarrassed that I haven't come across that question until just recently, but we will get an answer for that as well. Okay, thank you for the good questions. Filing requirements for US expats. We're on the final stretch. This is procedural information, but in case you're really wanting to get fully knowledgeable on the subject, you need to know these things. You must file your taxes by April 15th normally, but your deadline changes once you move abroad. In fact, you're not required to do your taxes until June 15th is the standard deadline for you as an expat. Like anyone, of course, you can also file for an extension, and that will give you until October the 15th. If you don't meet these income thresholds that are listed on the page here, then you're actually not required to file in the United States of America. You should also be aware that you will be required to fill out an F-bar. If the aggregate value of your foreign accounts exceeds $10,000, or about 9,200 euros today, at any time during the year, at any time, then you're going to be required to fill out the F-bar. So most of us are going to be doing an F-bar once per year. But don't worry, it's not very hard. There's also a form called Form 8938. This is normally an institutional form, but if you have good money here, if you exceed $200,000 on the last day of the tax year, or $300,000 at any time, then you're going to have to fill out Form 8938. I think that's the FCAT. And where's the FinCEN? Oh, that's going to be on the next page. So basically, every year you do your taxes. You're never not going to do your taxes because you're a U.S. citizen. Um, just remember, I always find this amazing. Europeans, once they leave their country of origin, they're not paying taxes back to their home, except of course for permanent income streams they receive from home. Only the United States has citizenship-based taxation. United States and Eritrea is my understanding. In Portugal, so in Portugal we have just finished tax season. Tax season ends on June 31st, and so June 30th, end of June. There it is, June 30th. So we have just wrapped up the tax year here, and when you file your taxes, you're going to file. I don't think that it's listed here. It's called the. Why is it escaping me? Form 3. Somebody correct me. Yeah, it's I think it's called the Form 3. In any event, you can do so by going simply over to the Finances portal, which if you are not familiar with the Finances portal yet and you live here, then you should definitely do so. Just like familiarizing yourself with the Portuguese tax treaty, it is something that will serve you well. Understanding how to use finances ably will tell you a lot about not only your deductions, but a broad range of other financial topics. Common pitfalls and how to avoid them. I'm not going to read through these. I have included all of these because I'd like to be able to provide you with a guide that you can read later, but we've covered most of these items already. And so I will just wrap up with this there are distinct phases to your process. And if you're a process-oriented person like I am, then it's better if we break things down like this. So some of us are in the pre-move stage. I've seen a few people here in the lobby that I know are in the pre-move phase. And at that phase, you can start working on things like figuring out whether you want to accelerate distributions from retirement accounts or making sure you have your estate planning in order before you move. Once you have acclimated to the new country, well, you've moved over. You now are making these decisions in real time. You're trying to figure out what type of real estate decisions you want to make, what you want to do with your investment accounts back home. This is where you often find financial advisors rolling up their sleeves and helping you parse through the different kinds of decisions that you have to make and their consequences. After that, well, you're in long-term global financial integration. Now you're a global citizen. Hopefully, you're engaging in thoughtful annual tax planning, and you're coordinating the allocation of your global assets. Once you've got all this figured out, well, then you might not even need someone like me. Goodness gracious. Charitable gifting, Social Security, Medicare. You're basically figuring out the sort of the end of life thing. Well, the third half, the the last one third of life. You're just sort of like kind of swimming along here, and one would think, um, sort of checking the same boxes with each passing year. And so this looks like sort of a bump for me, and it kind of is. Obviously, financial advisors, what is the best way to work with them? In my humble opinion, it is communicate, communicate, communicate. Um, Open lines of communication have always been my policy when I'm acting as an advisor. And in practically every role that I inhabit in life, I think, if you are being honest and open, then you can figure out just about anything in life. And be curious, I think, is really the kind of the name of the game. That was it. I wanted to keep this short, both because pensions are sort of a subsection within the broader tax subject, as well as I don't like to overdo it on topics that I think are somewhat straightforward. So I'm going to take questions now, and I have a few to start with, and then I will quit the room. The first question is from a gentleman, David. We have NHR, but we have yet to receive residency, nor will we be there 183 days in 2024. Will we still pay Portuguese taxes since we've registered our property there with finances and are thus considered a tax resident? That's actually such a smart way to play it, David. I'm glad that you did that because in order to qualify for NHR, this would have been the only way to make that possible, right? You had to become a tax resident, and now what do you do? Well, now you should probably drop your tax residency. So I know that feels a little bit convoluted, but that's really the only thing to do. There will be a limited time horizon there where you will have been considered a tax resident, and so you should consult with a tax specialist, a contabilista, or tax attorney, and just figure out what your exposure was during that time. I'm sure that it's minimal. I really am. Yeah, the Portuguese are not vindictive with their tax law, and so I expect that there's a good answer that you can pursue. Basically, there's a short sort of partial tax return you're going to be probably filing. That's what it is. Modelo tres. The tax filing in the U.S. is the 1040 or the 1040 EZ if you have an easy existence, but in Portugal it's called the Modelo tres. They have a whole range of models, and so yeah, not to be confused with Negro Modelo, a very fine Mexican beer. But that is the answer. Thank you. A question from Antonio: if you have a modest 401k, are you better off pulling out all of the funds at a 24% tax bracket before leaving the US if you'd be pulling out in Portugal at a 43 to 45% tax bracket? Well, Antonio, that's what I spend a lot of my time helping people to figure out because it's math. And so that is why it can be a little challenging because we have to look at the long-term uh, effects of pulling off that band-aid once. Or maybe there's a way that we can trickle the money out of your 401k every year, essentially keeping the tax bite lower year by year. Um, it's something that has to be explored mathematically. And so it's not something that I would prefer to give an easy answer to here. It's better left to spreadsheets. one of my one of my most romantic statements that I used to make back in my younger days is let's make a spreadsheet together. So that's that. And then there's one more question. Hi, John. Is there a wealth tax in Portugal? Are there any concerns with passive rental income from a U.S. property? Jeff, good question. Number one, no, there's no wealth tax, thank God. The only form of wealth tax I guess you could consider is we didn't talk about this, but there is an estate tax of sorts. There's something called the stamp duty. They don't have a straight estate tax, so you can die with $500 million here, and you're not going to be faced with a large estate tax unless you are not in direct succession with the decedent. That was a long sentence. I apologize. Are there any concerns with passive rental income from a U.S. property? Yes, there are. And that is something I've covered in another webinar, but I will tell you now, it is taxed at full Portuguese tax rates, unless you have an HR, in which case it's not taxed at all. And there may be other ways to mitigate the tax effect of passive income from properties, but that's something better left discussed one-on-one, I think, because it gets a little bit complicated. Yeah, I think that's it. I think that is. Okay, we did it, guys. That was another thrilling exploration into Portuguese taxes. There's always one more. Send an email with a few questions. That's how you do it. The last one was an observation. Send me an email with a few questions. Go ahead and do that because in case you haven't noticed, I do love to talk. I do love to study quite a lot as well, and I am trying to make myself available to answer questions and help you through these things. So please, please reach out to me one-on-one if either you want the slides or you want to engage with me one-on-one. Other than that, I'm going to give you the rest of your afternoon or your morning back. And thank you for your time. If there's one thing that all of us that are small business people appreciate, it's the time and support of people that enjoy working with them. Okay? Thank you very much. Have a great day. I'll talk to you very soon.